Hello everyone and welcome to Ticker.com's news channel on YouTube. On this channel, we review stock markets, discuss financial news, market trends, and economic data from Wall Street to Global Street. So let's dive in. U.S. payrolls gained at a faster pace in July, but gains were below the last one-year average. Non-farm payrolls increased 187,000 in July, higher than the downwardly revised 185,000 in June, the U.S. Bureau of Labor Statistics reported Friday. Economies polled by Ticker.com were anticipating payrolls to increase as much as 210,000 in the month. Monthly job gains were driven by increases in healthcare, social services, financial services, and wholesale trade. Job gains were below the 312,000 monthly average over the last 12 months, but significantly above the 70,000 needed to meet the demand from the rising working age population. The average hourly earnings for all employees on the U.S. private non-farm payrolls rose by 14 cents or 0.4% to 33.74 cents in July, matching the pace of increase in the prior month. Over the past 12 months, the average hourly earnings have increased 4.4% in July, matching the annual pace in the previous month. Jobless rate declined to 3.5%, and the number of unemployed changed little at 5.8 million in July, and the jobless rate has ranged between 3.4 and 3.7% since March 2022. After the release of non-farm payrolls, the yield on 10-year Treasury notes inched higher and traded above 4.2%, the level not seen since November. In other major news of the week, Fitch Ratings lowered its U.S. long-term credit rating to AA+ from AAA, citing persistent governance issues. Rating agencies have been slow in downgrading the U.S. debt, despite more than a decade of weakening governance, rising debt levels, and outsized military spending. Fitch also noted that the U.S. government deficit is expected to rise to 6.3% in 2023 from 3.7% last year. Fitch said the combination of tightening credit conditions, a slowdown in consumption because of elevated prices, and weakening business investments could lead the economy into a mild recession in the final quarter of this year and the first quarter of next year. Fitch placed the U.S. long-run foreign currency issuer default rating on negative watch in May at the height of the politically fractious debt ceiling negotiations. The rating agency highlighted the repeated debt limit political standoffs and last-minute resolutions have eroded market confidence in the country's fiscal management. We will now review the latest economic data from Europe. The euro area inflation slowed for the third month in a row to 5.3% in July from 5.5% in June, the statistical agency Eurostat reported on Monday. The ongoing decline in energy prices drove the overall inflation lower, but service inflation rose and core inflation was above overall inflation for the first time since 2021. Energy prices declined at a faster pace of 6.1% in July compared to a fall of 5.6% in June, and service inflation accelerated to 5.6% from 5.4% respectively. Core inflation, which excludes food, energy, alcohol, and tobacco, was unchanged at 5.5% in the month and was also higher than the overall inflation, signaling that the overall inflation is likely to stay elevated for a longer time than previously anticipated. Producer prices in the euro area declined 3.4% in June following an upwardly revised fall of 1.6% in May, Eurostat reported Wednesday. The ongoing decline in energy prices dragged down the measure of wholesale inflation for the second month in a row, and the index fell to the lowest level since 2020. The euro area economy expanded by 0.3% in the second quarter from the previous quarter, after waning inflation supported a slight rise in consumer spending, statistical agency Eurostat reported. From a year ago, the Eurozone economy rose 0.6%, the weakest pace of expansion since the recession over 2 quarters ending in the first quarter of 2021. Euro area retail sales declined 0.3% from the previous month in June, and retail sales in May were revised to 0.6% in May. On a yearly basis, seasonally adjusted retail sales declined 1.4% in June, slower than a fall of 2.4% in May, and fell for the 8th month in a row. In other news in the region, Germany continues to report strong trade surplus month after month, signaling healthy demand for its manufactured products around the world. German trade surplus expanded to 18.7 billion euros in June from an upwardly revised 14.6 billion in May, the Federal Statistics Office at Statis reported Wednesday. Seasonally adjusted imports fell 3.4% from the previous month to 112 billion, while exports edged 0.1% higher to 131 billion. On the jobs front, the euro area unemployment rate was stable at 6.4% in June. The number of unemployed declined by 62,000 from the previous month to 10.8 million, and jobless rate among people younger than 25 years fell to a record low of 13.8% from 14% in the previous month. Among the economies of the euro area, the jobless rate was highest in Spain with 11.7%, followed by Italy with 7.4% and France with 7.1%. Germany recorded the lowest unemployment rate of 3%. On the interest rate front, the Bank of England lifted its key rates following the rate hikes by the Federal Reserve and the European Central Bank. The Bank of England lifted its key lending rates for the 14th time in a row by 25 basis points to 5.25%. Interest rates in the UK are at the highest level since 2008, and central bank is expected to continue its rate hike campaign as inflation remains significantly above the target rate of 2%. The Bank of England revised its inflation forecast to 5% by the end of 2023, and estimated inflation is likely to reach its 2% target by the second quarter of 2025, quite far down the line. In other news, the UK home mortgage approvals rose in June as buyers rushed to lock in rates ahead of the rise in interest rates over the next several months. Net home mortgage approvals increased to 54,700 in June, higher than the revised 51,100 in May, the Bank of England reported Monday. The effective mortgage rate on a new contract increased 7 basis points to 4.63% in June, and the rate on the outstanding mortgage stock rose 10 basis points to 2.92%. Let us shift our focus now to Asia. China's official manufacturing activity survey showed declining activities for the fourth month in a row, the National Bureau of Statistics reported Monday. The PMI index for manufacturing industry edged slightly higher to 49.3 in July from 49.0 in June on weak domestic demand recovery and falling exports order. Any reading below 50 indicates contraction. Moreover, China's property market signaled more pain ahead for property developers and banks. Slowdown in China's property market continued in July, with major developers reporting a slump in contracted sales, further exacerbating their liquidity crisis. The contracted sales of China's top 100 developers totaled 350 billion yuan in July, falling 33% from a year ago and 33.5% from the previous month, according to real estate intelligence provider CRIC. The ongoing property market turmoil forced the People's Bank of China governor to pledge more support for the real estate sector after a meeting with leading developers. The two main problems faced by property developers in China are liquidity and sales. In the short term, the liquidity problems can be eased temporarily with more financial incentives from banks, but in the longer term, it will depend on the market demand and buyer confidence. In other news in Asia, Japan's unemployment rate eased to 2.5% in June from 2.6% in prior month. This was the lowest jobless rate since January, as the number of unemployed fell by 40,000 to 1.73 million, while employment grew by 190,000 to 67.6 million. We now take a look at stock markets around the world. The pop in Treasury bond yields overshadowed sentiment in the stock markets, and investors reviewed more than 1,200 earnings releases in the US and Europe alone. Stocks have been under pressure after Fitch cut the US long-term debt rating by one notch, citing expected fiscal deterioration over the next 3 years as the US government ramps up borrowing. Treasury yields spiked to the levels last seen in November as bond traders worry that the Fed will struggle to bring down inflation below 3%. In addition, the U.S. Treasury plans to borrow at an elevated pace for the next 5 months to finance the growing budget deficit. The yield on 10-year bonds traded above 4% for the second day in a row, and yields are likely to cross 9-month high. Stocks in real estate sectors and home builders fell more than 2% for the second day in a row after yields rose on Thursday. Prominent economists, investors, and bank executives panned the downgrade and said the action will have little impact on the Treasury debt market. Maybe so. But the U.S. government cannot just keep adding to already gigantic pile of debt without consequences. Ratings are critical metrics referred by institutional investors, and eventually investors will demand higher rates for weaker or weakening debt rating. It is a slippery slope, but neither politicians nor elites are in the mood to urge the government to take longer-term corrective actions and rein in the outsized debt. To put things in perspective, the U.S. federal government debt has jumped six-fold in the last 2 decades to about $32 trillion by the end of this year. World stock markets are entering into a consolidation phase after rallying for 9 months. Big tech companies were in focus for the second week as the earnings season picked up, and earnings releases dominated news flow, and large-cap technology, communication services, and consumer durable sectors are leading the 9-month rally in the U.S. stocks. Of the 9 leading country indices in the world, only the Hang Seng Index is down in the year so far because of ongoing weakness in property stocks. Banks in the U.S., Europe, and India are reporting strong earnings growth in the June quarter. We now turn our attention to individual stocks and latest earnings reports. Amazon.com reported a sharp rise in earnings after sales rose and cost-cutting improved financial performance. Apple reported mixed quarterly results after hardware sales stalled on the weakness in sales in China. Airbnb said bookings for nights and experiences are growing at a slower than expected pace. Semiconductor chips maker AMD said quarterly earnings dropped 94% and forecasted weak sales in third quarter. Starbucks said sales rebounded 46% in China, and the U.S. comparable same-store sales rose 7%. The luxury sports car maker Ferrari said vehicle shipments rose 17% in Europe, Middle East, Africa region, but declined by the same amount in North America, and total revenues rose 14% in the second quarter. French lender Crédit Agricole reported better than expected earnings on consumer loans and insurance demand. DoorDash, the food delivery service provider, reported quarterly loss shrank as sales and gross market volume rose. Shopify, the e-commerce platform, reported higher sales and gross merchandise volume, but quarterly loss expanded. Qualcomm, the smartphone chip maker, said quarterly revenue and earnings plunged on weak smartphone sales in China. Etsy, the online crafts marketplace, reported strong earnings but forecasted weak sales growth in the third quarter. PayPal swung to a quarterly profit in the second quarter and forecasted sales to rise 8%. Southwest Airlines declined after the company guided third quarter revenues to decline. WPP, the UK-based global agency, lowered its 2023 sales outlook. The French lender BNP Paribas announced a stock repurchase plan. The German state carrier Lufthansa reported second quarter earnings after passenger traffic rebounded but remained 14% below pre-COVID levels. Societe Generale returned to profitability and the French bank resumed its stock purchase plan. In summary, a wider group of investors now believe that the U.S. economy is more likely to avoid a recession because labor markets are still expanding and wages are rising and keeping the economic engine humming. Despite the slowdown in inflation, interest rates are likely to go higher in the U.S., UK, and Europe. Treasury yields for the 30-year bonds could jump as high as 5.5% from the current 4.3% in the next few months because of the rising borrowings by the U.S. government, and the rebound in oil and food prices could rekindle inflation. That's all for today, and we will see you next week, and you can read daily market updates on ticker.com.